Welcome back to our channel where we learn and reflect on compelling stories. Today, we are going to deep dive into one of the most infamous financial scandals of all time, the Bernie Madoff Ponzi Scheme. In this video, we'll unravel the intricate details of Madoff's scheme, how it unfolded, and the lasting implications it had on the financial world. Bernard Lawrence Madoff, born in 1938, was a prominent financier, stockbroker, and former chairman of Nasdaq. In 1960, he founded Bernard L. Madoff Investment Securities LLC, which quickly grew into one of the largest market maker firms on Wall Street. Madoff was highly respected, and his firm was considered a pillar of financial stability and trust. Madoff's Ponzi scheme began in the early 1990s, although some believe it may have started even earlier. The scheme was straightforward but incredibly effective. Madoff promised consistent high returns to investors, claiming to use a split-strike conversion strategy to generate profits. However, instead of investing the money, Madoff used funds from new investors to pay returns to earlier investors, creating the illusion of a profitable and legitimate business. To maintain this facade, Madoff relied on meticulous record-keeping and fabricated trading reports. He produced false account statements showing steady, positive returns which convinced investors that their money was growing. This deception was key to the scheme's success, as it built a false sense of security and trust among his clients. Madoff's reputation and connections attracted a steady stream of new investors, including hedge funds, banks, and wealthy individuals. However, the financial crisis of 2008 exposed the cracks in Madoff's facade. As more investors sought to withdraw their money to cover other losses, Madoff couldn't keep up with the demands. On December 10, 2008, Madoff confessed to his sons that his investment advisory business was a giant Ponzi scheme. The next day, they reported him to federal authorities and Madoff was arrested. In March 2009, Madoff pleaded guilty to 11 federal felonies, including securities fraud, wire fraud, and money laundering. He was sentenced to 150 years in prison. The fallout from the scandal was immense. Thousands of investors lost their life savings, and several charitable organizations were forced to close due to their investments with Madoff. One particularly tragic case involved the suicide of René Thierry Magon de la Villouche, a prominent investor who had lost over $1.4 billion of his clients' money. It exposed significant flaws in the regulatory framework, prompting the Securities and Exchange Commission, or SEC, to overhaul its oversight practices. The scandal led to increased scrutiny of investment advisors and stricter regulations to protect investors. One major regulatory change was the introduction of the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010, which aimed to reduce risks in the financial system and increase transparency. Additionally, the scandal highlighted the importance of due diligence and skepticism in financial investments. Many of Madoff's clients admitted to overlooking red flags, such as the consistent high returns that seemed too good to be true, and the lack of an independent custodian to verify the assets. This lack of due diligence allowed Madoff to operate his scheme for so long without detection. The long-term implications of the Madoff scandal continue to shape the financial landscape. Investors are now more cautious and demand greater transparency from fund managers. The regulatory environment has become more stringent, with continuous efforts to close loopholes and enhance the detection of fraudulent activities. The scandal also sparked a broader conversation about ethics and integrity in the financial industry, leading to increased emphasis on corporate governance and ethical standards. Moreover, the Madoff case has led to more stringent auditing standards and the requirement for third-party verification of investment strategies and assets. It has also inspired the use of advanced technologies like data analytics and artificial intelligence in fraud detection and prevention, making it harder for similar schemes to go unnoticed. The Bernie Madoff Ponzi scheme remains one of the darkest chapters in financial history. Its impact is still felt today, influencing how we approach investment, regulation, and financial ethics. By learning from this scandal, we can hope to build a more transparent and trustworthy financial system for the future. Thank you for watching. If you found this video informative, please like, share, and subscribe for more deep dives into financial history. Until next time, stay curious and keep exploring.